We'll begin. So good morning, welcome, and thank you for joining us for this edition of On Top of Tax. I'm Ollie Pumphrey and I'm a corporate tax partner based in the Southeast. Today, we'll be providing you with the key deadlines you need to be aware of and in-depth insights into hot tax topics. We will wrap up today's session with a short Q&A, so feel free to drop your questions in the Q&A box at the bottom of your screen. If we run out of time, don't worry, we will follow up with you afterwards. Today, I'm delighted to be joined by Simon Wood, who'll be covering the new transfer pricing guidelines from HMRC. Chris Rowe, who'll be discussing the new HMRC guidelines for compliance for VAT. And Joseph Larkinghouse, who'll be looking at exercising share options. Next slide, please. So before we get into the meat of today's session, just some key corporate tax compliance dates for you. First one, you may have heard there's a budget coming up. So budget days in a couple of weeks, on the 30th of October. We're expecting a business tax roadmap to be released on that day as well. Then looking forward, 1st of November is the corporation tax payment deadline for 31st of December 2023 year ends, where profits are below 1.5 million. And then at the end of November, good time to check your 2-year claims and elections deadlines and year-end prep for 31st of December 2024. So with the budget only 2 weeks away, it's certainly worth spending some time to see what we might expect on the day. Despite the warnings of a painful budget, for businesses, we're expecting the focus to be on growth, with announcements expected on planning reforms and countrywide hyperfast broadband rollout, whilst promises have been made in relation to giving companies more flexibility in how monies raised by the apprenticeship levy can be used. Labour committed to an industrial strategy in the King's Speech, as well as an alignment of the UK Infrastructure Bank and the British Business Bank under a new National Wealth Fund to unlock private investment. And just this week, we have seen details of both following the release of the Green Paper on the industrial strategy, entitled Invest 2035, and the National Wealth Paper, entitled Mobilising Private Sector Investment. The government has also recently confirmed that the definitions of micro, small and medium-sized businesses would be increased for administrative purposes, mainly affecting companies' house reporting, but there will be some bleed through into tax areas such as off-payroll labour rules for personal service companies. Lastly, here we're expecting 2 roadmaps, one for digital transformation for HMRC, though that's not expected until spring next year, and the second, a business tax roadmap that we are expecting on budget day, as I mentioned, and that will give a degree of certainty and insight around the future tax landscape for businesses. So announcements and promises have already been made, one being in relation to keeping the corporation tax rate at 25% and full expensing for capital allowances for the duration of this 5-year parliament. We could see a higher rate of bank levy and business rates reform to support the high street and higher taxes on the warehouses of online retailers. An increase to the national minimum wage is expected, and an increase in relation to the national insurance contributions employers make is possible following statements made by Jonathan Reynolds, the business secretary, and I'm sure you've seen press in recent days on that as well. New employment rights reforms have already been announced, and the fuel duty escalator may make a comeback. And lastly, higher taxes on betting companies have been talked about, and share prices of companies in that sector have adjusted in the last few days in advance of a possible announcement there. So Government is looking to fill a shortfall in the books. The number a few weeks ago is 22 billion. Today's number is 40 billion once you add in some spending cuts as well. And it's been made clear that painful changes will need to be made. So the question remains then what those changes will be and who they're likely to affect. This slide covers some of the more speculative predictions on where revenue may be raised. Clearly, we don't know exactly what announcements are going to be made until the day, and this by no means covers all the potential changes and announcements, but certainly looks at some of the more significant ones. So the existing nervousness from investors and business owners, we are already seeing people realise gains before any increases are introduced. So it's possible that the government have already made good inroads into raising tax revenues even ahead of the budget. And assuming that pre-election promises are kept and there's no fundamental shake-up of the tax system, there are actually a limited number of taxes that generate sufficient revenue that changing them will result in a materially higher tax take. For example, receipts from capital gains tax are approximately £15 billion, whilst IHT generates £7 billion. So together, in total, the £22 billion, which was the shortfall announced by Rachel Reeves last month. And whilst much has been discussed around increasing revenues from these taxes, a doubling of these alone would feel unlikely. So where else could she look? Well, during the election campaign, Labour ruled out increasing income tax, national insurance, VAT, corporation tax. And the final factor to consider is that Labour have said that they don't wish to increase the burden on ordinary working people. So taking all of these factors into account leaves the Chancellor with limited room for manoeuvre, but helps us identify where we are likely to see change. Whilst a wealth tax has been ruled out, we are likely to see a range of measures that apply to wealthier individuals, such as a lifetime cap to what can be held within an ISA. And the obvious areas outside of that are around capital gains tax, inheritance tax, and of course pension tax reliefs as well. So the capital gains tax changes may impact business owners with modest increases in rate applied. And we could also see some capping of reliefs, including those applying to a person's only or main residence. There's plenty of scope to change the landscape when it comes to reliefs afforded to pension savings and how they're taxed on the way out. We may see the reintroduction of the lifetime allowance for pensions in some form, only recently removed, as well as a standard rate of relief on pension contributions, where currently a 45% taxpayer receives 45% tax relief on contributions. This could be reduced to 30%. But as pensions are taxed at marginal rates at the time of withdrawal, this could see 30% relief on the way in and 45% tax on the way out. And that will need to be addressed or could drive investors to look elsewhere. The impact on public sector pensions will need to be carefully considered. Having recently agreed pay increases for public sector workers, restricting pension relief for that group of people would perhaps be a misstep. There could also be tweaks to the annual allowance, and they could look to use fiscal drag here and elsewhere. Finally, on IHT, there are many reliefs available there that could be closed or limited, although public opinions have shown resistance to that. Were they to come, changes could include restricting relief for AIM-listed shares, agricultural relief, and business property relief. Lastly, there has been work on non-dom reforms, and it is possible that the original proposals may be scaled back. Equally, there is already a consultation process underway on the taxation of carried interest. Ultimately, we won't know until lunchtime on the 30th of October, when hopefully all of our questions will be answered. And we'll be running through the announced changes in detail at our budget webinar the next day on the 31st of October. So fly through what we're expecting from the budget. Next up is Simon Wood to talk about the transfer pricing guidelines for compliance from HMRC. Do put your questions in the Q&A box. Keep those coming in, and we'll deal with them at the end.
Yep, thanks, Oliver. And yeah, good morning, everyone. I'm Simon Wood. I'm going to provide a quick overview of the guidance, which is probably easier said than done because it's over 100 pages long. I'll give it a go. And then I'm going to turn to how I think we and HMRC could be using it. Next slide, Cheska, please. So in essence, the guidelines represent best practice for TP compliance. HMRC are basically trying to tell us what they think good looks like and what their expectations are around price setting and documentation. There's 3 parts. I'd encourage everyone to read part 1. It's more geared around planning and managing compliance risk generally, and the other 2 are more technical, aimed at specialists and people like me and advisors, basically. And those sort of technical parts are HMRC calling out practices that attract greater HMRC scrutiny. So they really want to raise awareness around that and make clear what their expectations are. And then they also provide, helpfully or not, sort of flip side risk reduction recommendations to bear in mind. But it's also worth flagging that actually buried within the guidance are quite a few really good practical tools and checklists that people might find useful. So one example is there's a list of questions for non-specialists, so-called risk leads in particular. So that might be someone that's responsible for signing the tax return. And that's in part 1.3.3. And it's like a questionnaire, basically. You could adopt it like a questionnaire. It's there really for the business to use when, say, they're reviewing a functional analysis or a benchmarking prepared by specialists. A lot of it's sort of common sense, but I think it's a useful sort of crutch everyone could be using. There's a few other examples of questionnaires in there, so do have a look round. In terms of the relevance of this guidance, got there on the slide, it does apply to anyone in the UK rules, but to varying degrees. So what they're looking for really is a proportionate response. So if you're a small business with not much going on, cross-border, partial adoption or some level of adoption is okay. That's sort of encouraged. If you're more complex, then they'd be expecting towards the full adoption. If you're a really big group with lots of complex, IP transactions or something like that. So there's so much in there. Like I said, I've tried to boil it down to some key themes and some particular HMRC focus areas. So there's 5 bullets on the slide I'll try and talk to. So on the insufficiently evidenced positions, this is just a general message that keeps coming up, and it's across the board. So from record keeping through to the technical analysis you're doing, the documentation, and even then the implementation audit trail, like your calculations and the records of what you did. Non-UK prepared documentation and analysis is a concern. So here it's more around where there's not enough involvement of the UK business, and what they call insufficient localization. So they're basically saying we don't value your documentation if you haven't put enough effort in to get the UK business involved in it. So yeah, that message comes across loud and clear. There's a whole part devoted to so-called high-risk approaches. So that's part 3, really interesting because they're setting out areas that in particular HMRC sees high risk, and that might be transaction form or an approach you're taking to the analysis. So well worth having a look to see, well, do any of these apply to me? And what does that mean in terms of what I should be doing in self-assessing? Operational TP, key area of focus, and probably the first time HMRC have published stuff around this. They've given quite a few examples in there of common execution errors. So, you've got the TP method right, that probably agree with you on that, but actually how you've then executed it is incorrect for one reason or the other, and that can add up and become material. And then finally, the timing of work performed. Clearly, they want this to be done contemporaneously, like before you're signing the return is the ideal. And they've gone to great pains to explain the risks of leaving it all a bit too late, basically. So there's some stuff in there that definitely I think is worth a read. There's also a lot of you probably focus a bit more on the documentation, or I do. When I think of TP, I think of documentation. So there's a dedicated section in part 2.5 on that. And HMRC, I think, are getting a few things off their chest here. There's basically a list of a load of common documentation quality issues that they're flagging. Again, well worth having a look at. And a point they make a few times is that functional analysis that's too high level is of very little value to them. And I think it's a fair assumption that if you've got high-level documentation that's not right in your circumstances, of course, it might be acceptable. If it's simple and small, like I was saying earlier, it's probably a fair assumption you're more likely to get an inquiry if they request the documentation and they consider it to be insufficient. So it's also linked to that. They're beating the drum on a message around wanting facts to be more prominent and not blurred with the analysis or blurred into a position paper. So yeah, it's a key takeaway for everyone, I think, like having a clear divide between what's your evidence and fact base versus what's your inference and position, because that will lead, I guess, better trust and better impression if they get that feeling when they look at the report. And then finally, on this slide, just, well, it's not on the slide, but a final point is none of this is mandatory. The penalty regime hasn't changed, but the general tone throughout is like basically taxpayers, please be mindful of the level of work you're doing and whether you consider that reasonable in the circumstances. So yeah, next slide, please, Jessica. And so on this slide, I've tried to simply as I can summarize how I think the GFC could be used by HMRC and by taxpayers or UK businesses. On HMRC sort of general activity, I think they view the GFC as a raising standards initiative, trying to prevent errors before they happen, basically, which fits into their wider agenda, so-called upstream measures to increase yield. But I think in reality, this will be a useful day-to-day source of reference for inspectors, just how HMRC operate generally. So it will sit alongside their manuals, covering some, the manuals is very policy orientated. What positions do HMRC have on certain technical matters? This is way more on the practical side. So it could act as a tool, not just for us, but a tool for HMRC. And on the right side of the table, you can see there's basically there a full spectrum, all the core stuff of TP. I think this could be used for. And what I like about it is it gets into the real practical aspects of compliance, like not just part one, which is for the, you might not be a TP specialist at all. You might be a CFO, an FD or controller. Lots of sort of layman's term language as much as possible on how you should be doing things. And then in the part 2 and 3 gets more technical. So yeah, just be mindful of that when you're having a look through it. But stepping back, I think what's of most importance here is our key takeaway for me is that HMRC are trying to make is around good record keeping. And HMRC really flagging areas that they think require particular attention or things they want you to take a closer look at in the future. So some examples of that is they list things to look out for that have changed from a prior period. That could be an accounting change, for example, but also examples of business changes that you should look out for. And they define and list so-called trigger events, which is really helpful. The amount of times I've been asked in my career, can you give me some hooks and triggers around TP? Well, it's in there. So particular things that would signal that you should be doing more work. So obvious things like restructurings, but even things like changes to the UK people functions and reporting lines or new transactions, new products, new channels. So again, well worth looking for those sort of lists and reflecting how you might be able to build those into your controls or scoping, basically. And then they define so-called high-risk policy indicators. Again, like I was saying, this is so businesses can sort of check how their risk profile compares to HMRC's expectations. Are you doing something high risk or not? So that's in part 3, like I was saying. In terms of HMRC, this is an important point actually on the business risk reviews and inquiries bit to the table. It will change how HMRC approach risk reviews and inquiries. So they've in tangent already updated the manuals to point inspectors at this guidance when doing a risk review or handling an inquiry. So it's clear this guidance will be in the mind of inspectors going forward and the sort of information they might ask for. It will probably inspire questions and they will have in their mind the risk indicators, when assessing is this something they need to look more closely at. So that's almost it on the technical side. I'd say in summary, it's coming across as a bit of a plea, a call to action for everyone to spend a bit more time, particularly on the fact finding, and then of course on, getting comfortable that you've got the right support for the positions you're taking. But, the balance point is, whether or not you actually need to do anything will always be a reflection of your own facts and circumstances, and back to that point on proportionality and the burden of proof and materiality. So yeah, very much case by case what impact this will have. Next slide, I'm almost there. So I thought it'd be useful just you'll have these slides, but some links to the guidance itself. Just to flag as well, if you follow that link, you've not just got the 3 parts I talked about, but there's a really helpful annex, which is like a list, if you like, of example fact and evidence sources that you could have a look at. Well, we will in BDO, we're looking at it like, is this the sort of stuff we should be asking for as standard, for example, in a TP documentation exercise, for example. I've also put a link to our website. There's a brief summary I've put on there. And I've also written an article for Tax Journal that was published last week. It's about 3,000 words, but it's trying to boil it down. So, encourage you to have a look. You don't have to be a full-blown subscriber to read it. Tax Journal, if you follow that link, you can. As long as you register, you get a limited number of free articles a month. So I can't give it to you, sadly, because of my exclusivity that LexisNexis have and loads of legal stuff. But have a look, is what I'm saying. Cool. And then I think we're going to do a quick poll. I know, Chris, your face has appeared, but let's just quickly do this poll question. So I think you can get something should pop up in a minute. So the question is, how familiar are you with these new guidelines for compliance for TP? And it's around what impact that you think this is going to have on your TP. Said processes there, but just read that as generally the impact you think this might have on you. So I'll let you have a look at that. Probably leave it about 30 seconds or a minute, show the results. About enough time, Jessica? That's probably not a minute, but it wasn't a complicated question, was it? Here we go. Okay, so largest minority, slightly familiar. Yeah, that's probably in line with expectations. It was only published, a month ago. There's a lot in there. If you want to cheat, have a look at that Tax Journal article, or like I said, prioritize that part 1, because I think that will be of most use to most of you that are in the TP rules initially. Okay, thank you. Oh yeah, supposed to introduce Chris. Chris Rowe is
That's
going
right.
to cover the VAT version of this that was released a week after TP.
Cool. Thanks, Simon. Morning, everybody. So Chris Rowe. So I'm a VAT partner based in the Midlands. And one of my hats is I'm the VAT technology partner as well nationally. And these guidelines are very systems and process orientated. So that's why it's fallen with me. So I look forward to taking you through this guidance. It came out on the 18th of September, as Simon mentioned. So you might not have had a chance to have a look at this yet, but I'll give you a summary today, and then it'd be worthwhile having a look at as well. But before I talk about that, Francesca, thank you. Before I go into that, just the upcoming compliance dates. So picking on the VAT ones here, depending on your status, you might have instalment payments or return due at the end of this month, and likewise the end of November. And then for kind of probably most taxpayers, on normal VAT staggers, you'll have a VAT return due and payment due 7th of November, if that's where if you're on monthly returns or your quarterly stagger falls on that date. Right, getting into the meat of today's session then. Thanks, Francesca. So in terms of this guidance then, so it impacts all VAT registered businesses that do invoice accounting, so the vast majority of taxpayers essentially. And what it's about is going that step beyond making tax digital. So making tax digital, it's probably everyone on this call was aware, or is aware of it. It was all about automating the VAT compliance aspect of it. So you take the data out of the system that you need to do your VAT return, and about making sure that that process, so how we actually prepare the VAT return, was done in an MTD compliant way. So digital links, electronically filed, etc. What this guidance is about is saying, yeah, that's kind of one thing what we need to do, but actually, how about the full end-to-end process? So going upstream into the finance functions like AP and AR, procurement, expenses, etc. How have you embedded VAT controls and processes within those functions? And then that will then drive what data goes into the system. Then what you're doing in the system, how do you know that the system is controlling your data, so your VAT data correctly? And then, of course, the data then comes out of the system and goes into that MTD compliant process. So it's about addressing the steps prior to getting to the MTD compliant process, essentially. As like Simon mentioned for TP, HMRC in their guidance talk about proportionality. So depending on your complexity and size, and obviously with a VAT lens as well. So you might be, I suppose, a smaller business but really complicated for VAT, so like financial services, for example. Then that should drive how much you do, I suppose, in response to this guidance. But there's a kind of request for all taxpayers to obviously look at this guidance, then consider how robust your current consider how robust your current processes and controls are, and then to make a plan from there in terms of addressing any risks. So all taxpayers need to kind of respond to the guidance in that way. As I've kind of alluded to, it's very systems and process heavy, and we'll go through in a bit more detail what I mean by that to give you an example of one part of the guidance. And the aim here is to address the VAT gap, which for VAT is estimated to be about 8 billion currently. So they're really hoping this is going to increase the tax take, and essentially by reducing error. HMRC think there's a lot of error embedded within VAT return processes still. So that's what MTD was partially to address, but this is taking it that step further. So all culminating or resulting in a raised bar for VAT compliance, essentially. So if we go to the next slide, Francesca. Thanks. So there's 10 parts to the guidance. It's quite comprehensive, but it is actually really useful, I would say, and it's very practical. They go through kind of key finance functions and steps. So like if you look at order to cash, procure to pay, record to report, the kind of core embedded financial and accounting processes that you'll have. And it goes through each of those steps, breaks them all down, and says, these are VAT controls that you might want to consider having at each of these points. So it's very useful. The general approach, so part 2, That's very much about risk management and data management, I would say, within the system. So how are you controlling your master data? How do we know that's correct? How do we know VAT determination in the system, again, is what is working correctly? Because it's so key to then driving what reports we get out of the system and what ultimately ends up on the VAT return. There's some specific ones like around outsourcing and employee expenses. And then part 10 is all about errors, and it's very, very short, but it's essentially just saying that in looking at this guidance and reviewing your processes, you might actually realize you've got some errors. So it's just reminding taxpayers of obligations for when you need to disclose an error. But in my experience, if you're engaging with, if you're trying to do the right thing, essentially, it always stands you in good stead if you do have to go to HMRC and disclose an error. It's probably a good time to kind of review what your approach is to VAT accounting and ensure it's correct. And if it's not, under the cover of, look, we've seen this guidance come out and actually we have spotted a few errors, you'd hope that HMRC would look upon that in a good light. So if we go to the next slide, Francesca. So this is one of those parts, so order to cash, and HMRC set out these steps as broad steps within an order to cash process. So obviously starting with a sales order. So I'm not going to go through each of these, but just to give a flavour of what HMRC pull out. So at the sales order stage, it's obviously going to be very business dependent, this, but is it a customer we've already got set up in the system? Or if not, is it a new customer we need to onboard? If it's a new customer, do we capture things like their VAT registration number? And if we do we check that and do we make sure that's correct on a periodic basis? And then in terms of driving it through the system, coming back to that master data and VAT determination is going to be key to ensuring that the correct VAT treatment gets applied. We also might get cash at that stage, or we might get it later. So in terms of tax point, when do we need to declare the VAT on that transaction, and how does that work in the system? It's going to be critical. You then go on to kind of either we're going to be providing goods or it's services. So some specific controls in each of those. Then gets to invoicing. So again, then in terms of the tax invoice, if we're raising that in the system, what are the controls to make sure that the correct data points get picked up to produce a valid tax invoice with the correct VAT treatment? We might have self-billing. So I thought it was interesting that HMRC pulled this out, and it's again a real risk area which they foresee. So it talks about obviously first step, is there actually a self-billing agreement, a valid one in place between customer and supplier? That's critical for the invoices even being valid. But then if someone else is producing the invoice and it's not us, how does that work and how does that flow through our system? And then finally, just another example around credit notes. So if we are issuing credit notes, how do we make sure that a valid credit note is produced in the system? So which would involve referencing the original tax invoice, and clearly it's going to need to mirror/reverse the original VAT treatment that was applied to the tax invoice and making sure that's correct. So that's a bit of an example. If you go to the next slide, Francesca. So in terms of how should taxpayers respond? Well, as I covered at the start, HMRC are expecting you to assess your current processes and controls, so across the finance function. So that's kind of step one. And it might be, and I see this quite a bit, that a lot of taxpayers have controls, but they're not necessarily documented. So there might be an exercise around, okay, what we really need to do is get everything documented. As part of doing that kind of assessment, key is going to be actually understanding your end-to-end systems landscape as well. So what systems do we actually have? How do they feed in? Do they feed into a core ERP system? If so, are we comfortable that all the VAT data has been is being passed through the various systems correctly, and are there any controls in place? You'll then kind of have a gap analysis, which could be around documentation, training, and you'll be able to put a plan in place. So in terms of your response, there'll then probably be a piece where you need to brief any senior finance stakeholders, get budgets, etc., as needed. If you fall into the SAO, so senior accounting officer regime, this obviously dovetails quite nicely with that. So it would be kind of, do we need to address the approach or documentation as part of that. We foresee a lot of internal collaboration. So you might want internal audit, for example, could help if you have that finance function, could help with policing this. Also IT, HMRC talk a lot about automation, reducing the risk of errors. So it might be a case of, IT, how do we leverage automation tools? Then in terms of managing HMRC, as Simon mentioned, we expect this guidance to be referred to in business risk reviews, inspections, and in terms of handling of errors. So if you're trying to say, we made this error, but we're taking reasonable care, we'd expect HMRC to be asking questions around this guidance. And if you if we fast forward a year's time and you say, oh, not aware of that guidance, not done anything about it, it's going to be harder to prove that you have taken reasonable care in making that error. So you might be more likely to get a penalty. We'd also expect this to come up as part of due diligence as well, and also external audit. So that's in terms of how you might want to consider responding. If you go to the next slide, Francesca, we've got a couple of polling questions as well for this part. I appreciate people might not have had much time to have read this. It might be just off the back of what I've just talked about. But question 1 was, do you have documented VAT controls and processes embedded within finance? So for example, across accounts payable and accounts receivable. And then the second one is, how confident are you that your systems do produce accurate tax data? We'll give everybody a minute to answer that. But hopefully this session's been useful, and definitely urge you to have a look at the guidance. Give it another 10 seconds or so, Francesca. Okay, so yeah, so as kind of expected, most people have got partially documented controls and processes, but probably does need refreshing. I think that's probably as I expected. So at least you've got a good starting point. And then similarly on the systems, relatively confident. So yeah, undertaken some systems work, but it might have been a while. So yeah, we'll definitely. So I think it's probably as we expected, really. Taxpayers will have some documented controls to leverage on this, but it's just kind of refreshing it in light of this guidance. So yeah, thanks everyone for listening. I'll now pass you on to Joseph.
Thanks, Chris. Good morning, everyone. I'm Joseph Laughinghouse, and I work in the share plans and incentives team at BDO in London. And today, what we're going to discuss is we're going to run through the common equity incentive schemes that companies generally operate, how those work, how the tax landscape could change following the budget, and briefly discuss any planning opportunities around that. So before we dive into the discussion around share plans, I'm just going to give you a moment to look at this timeline of key employment deadlines to consider. So I'll just let this rest on the screen for 30 seconds to a minute, just so you can observe these deadlines. Thank you. So many companies operate some form of employee equity incentive. And very broadly speaking, these employee equity incentives can take two different forms. On the one hand, you have this category of non-qualifying plans, and those would include things like non-qualifying options, LTIPs, PSPs, that stands for performance share plans, or sometimes they call these schemes restricted stock units. So these plans can operate somewhat similarly, but they do come in different names. And then on the other hand, companies operate HMRC qualifying plans. And the main difference with the HMRC qualifying plans is those generally attract certain tax benefits. And just giving you two examples of common HMRC qualifying plans that companies operate are CSOP, Company Share Option Plan, and EMI, which is Enterprise Management Incentive. Although the tax treatment of those two different buckets or categories can be quite different, the mechanics in terms of how these schemes operate is generally quite similar. And what I mean by that is, generally, when you have one of these equity schemes in place, they often take the form of an option to acquire shares or a right to acquire shares on some future date, often referred to as vesting. The awards become exercisable. And usually that takes place on achieving a certain condition. And sometimes these awards, they vest, they become exercisable on achieving time vesting conditions. So it could be simply that you make the awards to your employees, they vest, become exercisable up to 3 years. Sometimes it's on a staggered basis in tranches. It could be 25% annually over 4 years. And then on the other hand, sometimes you have schemes that vest and become exercisable, not on a time basis, but instead on achieving certain milestones, certain conditions. For example, maybe the company wants to achieve an exit event and it becomes exercisable then, or on attaining certain performance targets, such as revenue targets. Next slide, please. So here I just wanted to give a brief overview on how these different schemes tend to be taxed. So if we look at the non-qualifying plans first, the way that works is when the initial right or the initial option is granted, generally there's no tax, and instead there's a taxable event arising when the shares are actually acquired pursuant to the vesting or the exercise of the awards. And generally what you would have with the non-qualifying plans is that's subject to employment income tax, often via PAY of the employer company, with national insurance also due. And then after the awards have been exercised, the employees sometimes hold on to the shares for some time and then sale. Any further growth in value from the time of the exercise until a future sale then attracts capital gains treatment. And then if we look at the HMRC tax advantage plans, those are somewhat different. And what I mean by that is the HMRC tax advantage plans can often be structured such that when the shares are acquired at the time of vest or exercise, there's no tax implication at all. And instead, when the individual sells the shares in the future, then what often happens there is the entire gain, which is the sales proceeds less any price that they pay for the shares, can attract capital gains treatment. And what's relevant in the world of share plans with the upcoming budget is the budget is widely expected to reform the capital gains tax rules. And it's not really clear what the changes are going to be yet, but what is clear is that we're expecting capital gains to be taxed more than they are currently. So, is it going to be in the form of increased CGT rates, or maybe they might do away or change the rules around business asset disposal relief? That they might change, reduce, or eliminate the CGT annual exemption. It's not clear at this point what changes are going to be made. It could be some of these, some combination of these, or they could introduce a different measure, which we're not aware of. But what we do expect is there's going to be changes to the CGT regime, which could mean there's more tax to pay on capital gains. Next slide, please. So if you're thinking about, the upcoming budget, potential changes to the capital gains tax regime, I guess the logical question is, what planning opportunities could there be for people to not end up paying more tax than they have to? If we look at non-qualifying plans first and just kind of think about that, if you have a company that operates a non-qualifying arrangement, and let's say employees have already exercised the awards and they already hold the shares. So maybe they've held the shares for some time and they're sitting on a capital gain in relation to those shares. They could sell those shares before the budget to lock in the current CGT rates on any gains. The key caveat to think around that is that, of course, assumes there is a market for the individual to sell the shares. So if the individual holds shares in a listed company, for example, and there's no holding period requirement or anything of that nature, then they can freely sell those shares. Even private companies sometimes have an internal market by way of an EBT. But it's worth bearing that in mind that if an employee holds shares and they're sitting on a capital gain on those shares, there is this question around whether there's a market for them to be able to realize that gain. So that's point one to consider around non-qualifying plans. If they're sitting on gains on shares, they might want to think about selling before the budget to crystallize at current CGT rates. Where you have non-qualifying plans and the awards have not yet vested, in other words, the individuals have not yet acquired the shares. And there's a question, which is, can anything be done there? At a high level, I would say there's limited benefit in accelerating the vesting of non-qualifying options. And the reason is, if the company is going to bring forward the vesting of non-qualifying options so people can exercise today, the full gain today when it's exercised will still be employment income treatment. And then it's only any further growth between today and the budget. It's only about 2 weeks, so it's not that much time for the share price to grow. It would only be any growth in that interim that would attract capital gains treatment. So if you think about it in that way, you can see there's limited benefit in accelerating the vesting of unvested options. So now let's talk about the HMRC tax advantage plans. So where companies operate HMRC tax advantage plans and the employees have already vested or exercised the awards, and they'll be sitting on a capital gain, again, they may want to consider selling the shares before the budget if there is the ability to do so to lock in the current CGT rates. In respect of any HMRC tax advantage plans where the awards are not yet vested, they haven't had the ability to exercise yet. The point to consider around that is generally with HMRC tax advantage plans, if you change the terms of those awards to bring forward the vesting, so you're basically changing a term of the option of the award, the HMRC plans, the way the rules work, that would generally cause the options to lose beneficial tax treatment. So the headline, I guess the key takeaway there is there's probably limited benefit in accelerating the vesting of HMRC tax advantage awards, although it should be considered on a case-by-case basis because sometimes there is the ability to accelerate the vesting without jeopardizing the tax benefits. Next slide, please. So what are the key takeaways here? It's widely expected that CGT rates in some way will be higher. There'll be more tax to pay on capital gains after the budget, although we're not really sure how that's going to look. So as discussed, whether a company operates a non-qualifying plan or an HMRC tax advantage plan, to the extent that employees have already exercised the awards and they currently hold the shares and they're sitting on any capital gains, then there may be a benefit for them to sell those shares before the budget if there is the ability to do so to lock in the current CGT rates, which are expected to be lower than what are going to be in place after the budget. And then when it comes to unvested awards, whether it's non-qualifying or HMRC tax advantage, the headline there is in both cases there might be limited benefit in accelerating the vesting, albeit for different reasons. So there might not be much material planning that can be done for the awards that are not yet vested. For the HMRC tax advantage plans, as I said in the previous slide, it should be considered on a case-by-case basis because sometimes you might be able to accelerate the vesting without jeopardizing the tax benefits, but you have to fall within very, very niche criteria for that to be okay. And the final point that I just wanted to touch on is this theme that we touched on here around the planning opportunity of selling shares now to lock in the current CGT rates. That's something that's been observed in the market, and a lot of independent research that has observed the sales of shares by directors of companies in the past many months has indicated that the sales of shares in the past many months is much higher than the same sale this time last year. And again, that's been attributed to the individuals wanting to have the capital gains that they currently have on their shares to be taxed at the current rates, which they expect to be lower than what might be in place after the budget. And the next slide, please. So that was it for the discussion itself. So what we have here is we have a polling question for you. So how well do you understand the tax implications of your company's share plans? And I'll give you a few moments to respond to that. Okay, so 42% don't have any schemes in operation. And for those that do operate scheme, the most popular response is 0.2, somewhat confident. So you have a general understanding, but need more clarity. Well, if you ever want to seek clarity, you can feel free to get in touch with BDO. We'd be happy to advise further.
That's great, thank you. And thank you to all our speakers today. Time for some Q&A. Do keep those questions coming in into us using the box at the bottom of your screen. There should be a Q&A button where you can submit those. So if I can invite the panelists back, as you start Joseph, with you, had one question come in. What should a company consider when choosing an appropriate employee share plan for their business?
Thanks, Oliver. So the first thing to consider is I would say the first point to consider is what the company is trying to achieve commercially and what it's trying to achieve with the share plan. Is it purely a retention tool, or are they trying to drive people to achieve a certain event, maybe certain performance targets or an exit event, so that the plan can be tailored for that? So the commercial objectives and aligning with that is the first thing to consider. The second point that comes to mind is whether or not you can structure that arrangement under a tax efficient umbrella. So if you can get that structured to qualify for the tax benefits, which would be great. And then the final thing around choosing and structuring an incentive plan, I would say, is around participation. Is it intended to be just for a few key management or the wider workforce? And there can be implications around the optimal scheme choice given how much participation. So I would say those 3 points: commercial drive, tax efficiency, and participation.
Thank you. We have had a question about the slides. Yes, they'll be shared after the event, so you'll be able to access all the links, etc., and the detail in the slides after the event. Looking at the next question, it's asking, what's your prediction on capital gains tax, particularly with regards to headline rates, business asset disposal relief, and effective dates? Well, gosh, quite a lot potentially to cover off there. I think there's obviously been a lot of column inches talking about the capital gains tax rate. The Lib Dems in the past have talked about, and others have talked about, aligning capital gains tax rates more closely, at least, to income tax rates. Although Keir Starmer's recently rejected the idea that they were looking at the sort of 39% rate. So capital gains tax rates generally at the moment about 20%, depending on what you're doing and who you are, and a higher rate of 24% if you're selling an additional property. So could the rate go up? Yes, absolutely. What would it go up to? I think it would have to be a marginal increase. Where it was being modelled and discussed before, there's talk about it raising £5 billion, but there's certainly a school of thought that says that if you increase rates too much, you actually end up potentially losing tax revenues. There are certain activities underway. I mentioned the consultation on carried interest, so as a specific measure that they're looking at. So it may well be that they're being more targeted, and with any increased rates, there's always the other factors to consider. They might look at reintroducing a sort of tapering relief to take into account any inflationary gains, so that they're not taxed. So obviously, we don't know the answer exactly. Would not be at all surprised to see an increase, though I think it would be modest. On the question around business asset disposal relief, I mean, this is a relief that's been around for a while. What it does, for those who aren't aware, is it applies a lower rate of tax, capital gains tax, 10% rather than 20%. Essentially, if you sell a business, the allowance or limit for that in the past has been up to £10 million. It's currently £1 million. It's not much loved other than by business owners who see value in it. I think it could end up being more of a political decision, perhaps, rather than a tax policy one. And it is thought that scrapping it would save £1.5 billion. So there's not there's not a huge amount at stake as far as the government are concerned, but it is widely used for things like enterprise management incentives that can fall within business asset disposal relief as well. And just to touch on the last question around effective date, when might such an increase take place? Again, differing schools of thought. Is it going to be overnight? There is precedent for that, but I think the consensus feeling is that it wouldn't be until April next year, and part of that is to encourage people to realise gains in advance of then, and to sort of generate more tax between now, the budget, and the date when any new rate was introduced. There is some word that HMRC find it practically difficult to have sort of multiple rates within a year, that their systems struggle with it a bit, and obviously it would be more complex for taxpayers and advisors alike. So my expectation would be April next year, but there is precedent for it to be an overnight change. Just working my way through some of the questions. Are there any costs of setting up qualifying share schemes? Shows lots of interest in share schemes.
Thanks, Oliver. And thanks for the question. Yes, there are costs of setting up HMRC qualifying schemes. Just a few things that will need to be considered is if the company meet the qualifying conditions. So if you're looking to implement EMI or CSOP or another scheme, there are certain qualifying conditions that have to be met. So that has to be stepped through. And then secondly, you'd want to think around the commercial terms of the schemes. So there's this work around the heads of terms, designing the key features, any performance conditions and so on. And then there's a third piece, which is around the implementation, where the legal documents are drafted and employee communications are done, and sometimes evaluation work needs to be done to place a value in the shares as well. So those are the different stages that you need to consider around the implementation of a new scheme, and there are costs involved with each of those stages, if assuming an advisor is appointed. But what we find is the tax savings can be quite substantial, and it's quite important for companies to have a scheme that aligns with the commercial objectives. So it's the kind of thing that we'd be happy to help with, should you want to discuss further.
Great, thank you. Just quickly try and tick off a couple more. There's a question for you, Simon, on transfer pricing.
Yeah, in terms of who it's aimed at, and the question is it aimed more for UK outbounds? I'd say it's not. They don't aim it at any group in particular, inbound or outbound, but there'll be elements that are talking to, say, inbounds actually, where it's a complaint might be non-UK prepared documentation that's had insufficient involvement of the UK business. That pointer is making around insufficient localization. So there's an inbound angle, but also outbound too, but that's more around the general principles of the size, nature, complexity. To the point I was making, they're encouraging you to take a proportionate approach. So in the question, if you've got little overseas presence and you're UK based, then you're going to be low down on that spectrum of size, nature, and complexity. So little of the guidance will probably be relevant. It's written very idealistically. So I hope that helps. It's not strictly positioned at anyone in particular. You've sort of got to work it out for yourself on your facts and circumstance.
That's great, thank you. There are a couple of questions left outstanding. Sorry, we haven't had time to reach those. We will get back to you individually. So looking ahead, upcoming events, we have on the 30th of October, part 17 of our ongoing tax automation and innovation webinars, which are 30-minute snippets designed to arm tax and finance leaders with the information they need to create efficient and low-risk tax processes. The autumn budget webinar, the day after the budget, the webinar being on the 31st of October. 20th of November is the next on top of tax webinar. And then on the 27th of November, a week later, the workplace evolution webinar, which is part 3 of our new workplace evolution series, where our expert panel will be looking in detail at what a worker in 2024 really values, and how an organisation should respond to this. So please do sign up to our monthly On Top of Tax newsletter to get a monthly roundup of the most important tax updates from BDO, plus exclusive invitations to our webinar series. For quick updates and insights, join our On Top of Tax group on LinkedIn, where we share timely BDO tax news. So as the clock strikes 12, I will close by saying thank you to our panelists. Thank you for everyone attending for your questions, and goodbye. Goodbye.